Imagine you're already investing in a high-yield ETF, enjoying monthly payouts, and then, out of the blue, the fund makes a major change to its investment strategy. More risk, more complexity, and potentially higher returns. But at what cost? YieldMax has just made some significant changes to its prospectus, and today we're going to break down exactly what this means for your investment, the risks involved, and how to approach these changes as an investor. If you've been following YieldMax ETFs, you're probably aware that they've been gaining attention for their high-yield distribution strategies. These funds, such as MSTY, NVDY, and TSLY, use synthetic covered call strategies to deliver eye-popping yields, often in the 13% to 100% range annually. But as the yields have grown, so have the risks, particularly around net asset value, or, as it's commonly referred to, NAV erosion. Now, YieldMax has made some major changes to its prospectus, and these new strategies could make an already risky investment even more volatile. Let's dive into the details of these changes, what they mean for you, and how to navigate the added risks. YieldMax updated the prospectus for all its funds. Here are the new strategies and risks that you should be aware of. Swap contracts are now part of the investment strategy. Essentially, a swap is an agreement between two parties to exchange financial returns based on a specific underlying asset. Instead of directly investing in the stock, for example, Tesla or Nvidia, the fund could enter into a swap where it receives exposure to the stock's price movements without actually holding the stock itself. Let's say the YieldMax fund wants to track the performance of Tesla without directly owning the stock. The fund might enter into a swap with a counterparty where they agree to exchange returns based on Tesla's performance. The fund benefits if Tesla goes up, but doesn't own the stock outright. But here's the risk. Swaps are over-the-counter contracts, which are less transparent than exchange-traded products. The risk of counterparty failure is real, meaning if the other party in the swap doesn't uphold its side of the deal, the fund might not achieve its expected returns. YieldMax funds may now purchase deep-in-the-money call options. To understand this, let's first break down what a call option is. A call option gives the fund the right, but not the obligation, to buy the underlying stock at a specific price. Now, a deep-in-the-money call option is a bet where the stock is already significantly higher than the strike price of the option. Essentially, this is a bet on even bigger gains. If the stock continues to rise, the fund can profit more. Let's take Nvidia. Suppose Nvidia's current stock price is $500. The fund might buy a call option with a strike price of $400. If Nvidia's price goes up to $600, the fund profits significantly from that rise. However, if Nvidia's price falls or doesn't move, the option could lose value, resulting in bigger losses. So, while these options have the potential for higher returns, they come with greater risk, especially if the stock doesn't perform as expected. Finally, YieldMax funds may now directly purchase equity securities of the underlying stocks. This means that instead of just using options and swaps to track a stock's performance, the fund might actually buy the stock and hold it in the portfolio. If YieldMax decides to buy shares of Tesla directly, it will now have full exposure to the stock's price movements. If Tesla goes up, the fund benefits, but if Tesla crashes, the fund suffers the full loss, just like any regular stockholder. This adds more direct exposure to stock volatility. While these changes provide more opportunities for returns, they also introduce more risk. Let's break down what could go wrong. Swaps are complex financial instruments that can be risky. They depend on the counterparty, and if that counterparty fails or is unable to uphold the agreement, the fund may lose its exposure to the underlying stock. Moreover, swaps are typically traded in the over-the-counter market, meaning they are less regulated and less transparent than other market instruments. This makes it harder for investors to fully understand the pricing and risks involved. The problem with buying deep-in-the-money call options is that they amplify the bets on the underlying stock. While they could generate huge profits if the stock goes up, they also come with increased risk. If the stock price doesn't move in the expected direction, the fund can experience substantial losses. Additionally, as we mentioned, the options strategy caps the fund's upside. So, if the underlying stock surges, the fund won't fully participate in those gains. On the downside, if the stock falls, the fund loses significantly. By adding direct exposure to the stock, the fund is now subject to the same market risks that affect individual stocks. If the broader market drops, the fund could see significant declines, even if the individual stocks in the portfolio are still strong performers. So what does all this mean for you as an investor in YieldMax funds? YieldMax is increasing its exposure to the underlying stock through swaps, deep-in-the-money options, and direct equity ownership. This could mean higher returns, but it also increases the volatility of the fund. If the stock performs well, you could see greater gains, but if it drops, the losses could be larger than before. The fund's investment strategy is becoming more complicated with the introduction of these new tools. Swaps and options strategies add layers of complexity, making it harder for retail investors to understand exactly how their investment is performing. The funds now have greater exposure to stock price fluctuations. While this can boost returns, it can also lead to larger swings in net asset value, especially in volatile markets. Given these changes, here are a few strategies to protect your investment. Keep an eye on the net asset value of the fund. This will show you whether the fund is experiencing any sharp declines in value. If the NAV is consistently dropping despite high distributions, it could be a sign of NAV erosion. Make sure you fully understand the risks involved with these new strategies, especially swaps and deep-in-the-money call options. These are high-risk strategies that could lead to significant losses if things go wrong. Since YieldMax is becoming riskier with these new strategies, you might want to diversify your portfolio. Don't put all your money into a single YieldMax fund. Balance it out with more stable investments to reduce your overall risk. As the fund is more exposed to stock price fluctuations, be sure to track the volatility of the stocks the fund is investing in. If the underlying stock is highly volatile, the fund will experience greater NAV erosion. I know some of you might be thinking, this is all just BS, high-risk talk meant to scare people off. But here's the reality. Investing in high-yield funds like those offered by YieldMax does come with significant risks. It's not about being negative, it's about being realistic. The fact is, YieldMax funds use complex strategies, like options and swaps, that are designed to amplify returns, but also magnify losses. High yields sound attractive, but it's crucial to understand the trade-offs. I'm not telling you to avoid these funds, I'm just encouraging you to go in with your eyes open. Every investment strategy has its pros and cons, and the goal is to balance those risks with your financial goals. Ignoring the risks can lead to unpleasant surprises down the road. In conclusion, YieldMax's May 2025 prospectus change introduces new strategies that could potentially increase returns, but also add more risk and complexity. The use of swaps, deep-in-the-money call options, and direct equity securities increases exposure to the underlying stocks, amplifying both potential gains and losses. While these changes offer higher returns, they come with significant risk, especially during periods of market volatility. As an investor, it's important to stay informed, understand these new strategies, and monitor your investment closely to ensure you're managing risk properly. Always balance high-risk strategies with more stable assets in your portfolio, and keep track of the NAV to catch any early signs of erosion. Thanks for watching, and make sure to subscribe for more insights on high-yield investments and strategies.